In 1988, Pat Riley, then of course coach of the Los Angeles Lakers, filed to register the trademark for a term called three-peat. Now the phrase, of course, would become iconic in sports and things even beyond sports. Since then, in fact, it's been implemented 4 times in professional sports. And well, now it looks like for the S&P 500, we're poised for another double-digit gain. In fact, my next guest says that the achievement is even more remarkable considering we had that 19% tariff swing earlier this year and a whole lot of anxiety. So let's bring in CFRA, their chief investment strategist, Sam Stovall. Sam, you know, in hindsight, I think we should, I want your thoughts, like just how remarkable has this year been? Because this market was written off more than once.
Hey, Charles, good to talk to you as always. Yes, it has been a very remarkable year and a three-peat at that. But then again, I think we also needed some magic for that to occur. I say that because the S&P was down 19% through April 8th. Yet we're still likely to post a mid to high teens return for the full year. So a lot has gone very well this year for us.
All right, so we have the table up. The Houston Comets had a four-peat. Now, I think you're saying no cigar to the S&P 500 making a double-digit gain next year, but you do see us being up.
I do. We have to go back to 1942. There had been, that's 84 years. We have had 3 three-peats, 2 four-peats, and only 1 5-peat. So in that 84-year period, you know, we've not had a lot of continuous years strung together. They're usually 2 and then down, 2 and then down, et cetera. So my belief is that a midterm election year, which is typically the most challenging of the 4-year presidential cycle, gaining an average of only 3.8% and rising no better than a coin toss, also having a drawdown of 18% on average, I think will make for a pretty challenging 2026.
All right, let's talk, though, about your macro backdrop, because you do see revenues and earnings higher next year for the S&P.
That's right. I have a year-end target for 2026 of 7,400. So I guess you could say it'll likely be a good year, but not a great year, or a bull market, but still with a lowercase b. I think the economy will remain resilient. We are not headed for recession. Interest rates are likely to continue to creep lower as the inflation rate goes to about 2.4% year on year for core PCE by the end of 26. So those should be good. My target, being more of a weather vane than a laser beam, basically says stick with the market, just don't go too far out on the risk curve.
Right, you've kind of already highlighted here. We'll just flash the screen for the audience, though. Valuations obviously are really high, has a lot of folks, there's a lot of anxiety there. The Buffett indicator has been elevated for a long time. They're sitting on $400 billion in midterm elections. But let's talk about opportunity for a moment. Sector overweights, communication services, financials, and information technology. I mean, essentially, you're saying that the winners are going to continue to lead us. So, because a lot of folks are talking rotation, but it seems like you're saying stick with the winners.
That's what history basically tells us. Going back to 1990, if last year was a down year, you wanted to buy last year's losers. If last year was an up year, as obviously 2025 will be, you want to stick with your winners. And by doing that, owning the 3 strongest sectors in that prior year, you beat the market 70% of the time and outpacing it by about 300 basis points. And if you looked a little deeper at the 10 best or worst sub-industries based on whether last year was up or down, you beat the market again by more than 70% of the time and did so by more than 700 basis points. So basically, history says if it's working, don't run from it.
Sam, I got your picks. I'm going to read the symbols out loud because we have a lot of listeners on radio. AEIS, Flower, FLS, and WGO. But I've got to ask you about AEIS. It's a name I'm unfamiliar with. Advanced Energy?
Yes, Advanced Energy is an electronic equipment company that we think should continue to benefit from a structural shift toward the higher power density computing architectures. As you know, I like to look for both the fundamentals and the technicals, and both are positive by CFRA equity analysts as well as our Lowry technical arm. And basically, this company has services that address the infrastructure needs across AI data centers, next generation semiconductor computer manufacturing, as well as industrial automation applications.
I love the fact that you're drilling deeper and deeper into that story as that broadens out. And by the way, great looking chart as well. Sam, thanks a lot, my friend. Merry Christmas if we don't talk again before then.
Thanks, Charles. Same to you.
All right. So